So for whatever reason, bar company is interested in better understanding their balance sheet. Now, if we skip to the last section of this question, it says, what is bar company's price to book ratio? So ultimately, they are choosing to calculate the price to book ratio. And as we know, this ratio, it just compares the market price to the book value of the company. And this is going to be on a per share basis in this question, because what we're given is a current stock price value of $12 per share. So we have the numerator here. But what is the denominator, right? We need the book value per share. So there's going to be two steps we need to perform before we can get that book value per share and then ultimately calculate the price to book ratio and get the right answer. So our first step is going to be to calculate the book value in total, right? This isn't on a per share basis. This is just total book value. And book value is similar to net assets or equity, right? And the question gives us assets of 120,000 and liabilities of 80,000. Well, we know assets equals liabilities plus equity. So that means if we take assets of 120,000, subtract liabilities of 80,000, we're going to get the equity or book value of the company, which is $40,000, right? So now we have the book value, but we still need to get to that book value per share. Well, they have 5,000 outstanding shares. So in step 2, we're just going to take that book value of 40,000, divide by outstanding shares of 5,000, and guess what? That tells us the book value per share is $8. So now that we have the market value per share, or the current stock price, and we have the book value per share, we are ready to help bar company calculate their price to book ratio. So the market value per share is $12. Question already gave us that. And then that book value per share from step 2 is $8. Just divide those two, right? And we get a price to book ratio of 1.5. So 1.5 is going to be the correct answer here. Now, you have to think about why we would calculate this ratio. Well, in general, the one thing I can say is that their market value is greater than their book value, right? So investors must think there are some long-term prospects here because they're saying, okay, let's pay a market price that's greater than the book value. Now, we don't know whether this is a good ratio overall. We could compare other companies and see what their price to book ratio is, but that is the best way to use this ratio, is to look at how it stacks up to other companies that are comparable, right? Looking at this ratio on a standalone basis, it just doesn't tell us that much other than the market value is greater than the book value, and the ratio here is 1.5.